What the heck is going on down here? I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
A history-making 777-point nosedive. The NASDAQ plunged almost 10%.
Wall Street's of the view that something needs to be done, and I think most investors are of the view that something needs to be done, and it didn't get done.
And we do know that now that the fall of Lehman Brothers really froze the credit markets, of course, and really helped spark the worst financial crisis since the Great Depression.
September 2008, Lehman Brothers collapsed. Markets froze, millions lost their homes. You were told it was a housing crisis, bad loans, greedy bankers, or one party's fault. See, that was only part of the story. The real story goes back much further, and it's not about Democrats or Republicans. By the end of this video, you'll see why the next crisis isn't a matter of if, it's when, and what that means for your money. For years, I thought that one side caused the crash. I thought if we just voted differently, if we argued harder, if we exposed the right people, things would change. Meanwhile, families were losing their homes, retirement accounts were disappearing. Parents were trying to explain to their kids why everything felt so uncertain. We kept arguing about Republicans versus Democrats, but the system running underneath it, it was neither Republican nor Democrat. Think of it like a bird. We argue about whether the left wing or the right wing is better, but in actuality, both wings are attached to the same bird. And the body, it runs on debt. If we want to understand what really happened in 2008 and what's coming next, we have to stop watching the wings and follow the green. The machine didn't start in 2008. It started in 1913. You see, that's the year that a group of bankers and politicians, they created something called the Federal Reserve. And what exactly is the Federal Reserve? It's America's central bank. Its job is to be the lender of last resort, to keep money flowing when things get tight, and also to create stability. And at first, that seems like a good idea. But here's the thing about stability built on borrowed money. It could turn into something else, something fragile. In the 1920s, money was cheap. Credit was easy. Everyone could borrow. People were buying stocks with borrowed money. Prices kept going up. Everyone thought, hey, if things are going to keep going up forever, then risk on. You see, that line of thinking, that's called a bubble. And where prices rise, it's not because things are worth more, but it's because everyone believes that they'll keep rising. And then 1929 hit. That same bubble popped. Stock market crashed. Banks started failing. See, here's what most people don't understand about bank failures. When you deposit money in a bank, the bank does not just keep it in a vault. They lend most of it out. So when lots of people try to withdraw their money all at once, the banks didn't have it. And that is known as a bank run. And when enough banks fail, it triggers something even worse. It's known as deflation. Deflation means the general price level of everything falls. Sounds good at first, right? Your money buys more. But here's why it is devastating. When prices fall across the economy, businesses, they earn less. And when businesses earn less, they cut jobs. When people lose their jobs, they stop spending. When people stop spending, prices fall even more. It is a vicious cycle. And here's the killer. Your debts do not shrink with deflation. So imagine, you owe $100,000 on your farm, but now your crops sell for half of what they used to. You still owe that $100,000, but you're earning half as much. The debt becomes impossible to pay. And that's exactly what happened to millions of families. They lost everything. For years, the economy, it just kept shrinking. And that, my friends, was the Great Depression. By 1933, things were so bad that President Roosevelt did something dramatic. He ended the gold standard for Americans. Before this, you could trade your dollars for actual gold. You see, the dollar was tied to something physical, something that was limited. And after 1933, the government had more freedom to print money, to create credit, to fight deflation. Not because they wanted to reward anyone, but because the alternative was total collapse. Then in 1971, underneath Republican President Richard Nixon, he finished what FDR had started. He cut the dollar's last tie to gold. This time it was internationally compared to what FDR did, which was only domestically. Now the dollar wasn't being backed by anything physical. It was just trust, just credit, just a government's promise. Now look at this pattern. We have the creation of the Federal Reserve in 1913. And then in 1933, we have the cut to the domestic gold tie underneath a Democrat. And then 40 years later, approximately in 1971, we have the cut to the international gold tie underneath Republican President Richard Nixon. Different presidents, different parties, and yet headed in the exact same direction. Because this ends up being more flexibility, more ability to create money, and more reliance on credit from a government standpoint. Now the question is why? Well, that's because the alternative, letting everything collapse, that is just political suicide. So no politician survives a depression, not a Democrat and not a Republican. So here's what you need to understand. Modern economies, they run on credit. Credit just means borrow money. When you take out a mortgage, that's credit. When a business gets a loan, that's credit. When the government sells bonds, that's credit. Credit makes the economy grow. It lets you buy a house before you save the full price. It lets businesses expand before they've earned full profits. It lets the economy move faster. But credit creates a problem. The more credit you create, the more unstable things become. And here's why. When you borrow money to buy a house, you're betting that that house will be at least what you paid or more. When a bank lends you that money, they're betting you'll pay them back. When an investor buys a security built on your mortgage, they're betting that the bank was right. Everyone's betting on everyone else. As long as prices keep going up, everyone's happy. You can refinance, the bank makes money, the investor gets their returns. But what happens when prices stop going up? Now you owe more than your house is worth. The bank's loan is underwater. The investor's security is worthless. This is called deleveraging. Leverage simply means using borrowed money. When things go bad, you have to unwind all of that borrowed money. So people default on their loans, banks fail, investors lose everything, prices fall further, which causes more defaults, which causes more failures. This is the doom loop. And when it really gets going, when falling prices and unpayable debts feed off of one another, it's called a deflationary debt spiral. In a deflationary debt spiral, prices fall, debts become harder to pay, people default, banks fail, credit disappears, spending stops, businesses close, jobs, they vanish, and it all feeds on itself. This destroys wealth. It destroys jobs, it destroys retirements, and it destroys governments. Politicians fear this more than anything else, because inflation, when prices rise, that hurts over time. But a deflationary debt spiral destroys everything at once. Inflation erodes your purchasing power slowly. A deflationary debt spiral wipes out the entire economy. So when things start tipping into that direction, when the spiral starts spinning, the government steps in. Now, I said all of that to say this. 2008 didn't start in 2008. You see, everything started in the early 2000s, specifically after the dot-com crash in 9/11. The Federal Reserve, they dropped interest rates really low. You see, this was supposed to help the economy recover, and it did, sort of. But here's what else happened. When interest rates are low, borrowing is cheap. When borrowing is cheap, people borrow a lot. Banks suddenly had all this cheap money they needed to lend it out to someone. Enter the housing market. You see, banks started giving mortgages to everyone. If you had good credit, you got approved. Bad credit, approved. No income, you got approved. You have no down payment, that's not a problem. You got approved. They even went so far as to create something known as a ninja loan, which means no income, no job, and no assets. And you could still end up getting a mortgage. Why in the world would banks even do this? Well, because they weren't keeping the loans. You see, they were packaging them. And here's how it worked. Step one, bank gives you a mortgage. Step number two, the bank then bundles your mortgage with 1,000 others. Step number three, banks sell that bundle to investors as a mortgage-backed security. And then step number four, the bank collects a fee and they simply move on. The bank doesn't care if you can actually pay. They already sold your loan, so the risk is now someone else's problem. Then it got worse. There were rating agencies, companies whose job was to tell investors, is this investment safe? See, these agencies looked at those bundles of mortgages and stamped them AAA. That's the highest rating. That means safe as US government bonds. Pension funds saw the rating and brought them. Insurance companies brought them. Foreign governments even brought them. Everybody wanted in. Meanwhile, the housing prices, they kept climbing. Everybody believed they'll keep climbing forever. If you couldn't afford your mortgage, no problem. Just refinance or sell it. Because prices only go up, right? Wrong. By 2006, prices stopped rising. By 2007, they started falling. And that's when the trap sprung. Millions of people had something called adjustable rate mortgages. For the first 2 years, the payments were low, affordable, but then they adjusted. Suddenly, payments doubled. People who could barely afford the teaser rate definitely couldn't afford the real rate. They tried to refinance, but banks said no. Why? Because now the house was worth less than the loan. They tried to sell, but no one was buying, so they defaulted. One family, then 10, then hundreds, then thousands, and then millions. And remember those mortgage-backed securities, those safe AAA rated investments? They were full of these failing mortgages, so the security started falling too. But here's the part that made 2008 so different. Those securities, they weren't just sitting in investment accounts, they were collateral. So banks had borrowed against them. Hedge funds had borrowed against them. Some firms had borrowed $30 for every $1 that they actually had. That's something known as leverage. So when the value of those securities dropped by 10%, firms that were leveraged 30 to 1 were completely wiped out. And that triggered something called a margin call, which is when your collateral loses value. Your lender says, give us more money now, or we're selling everything. So firms, they had to sell, and fast, which pushed prices down even more, which triggered more margin calls, which forced more selling. The doom loop. March 2008, Bear Stearns, one of the biggest investment banks, was about to collapse. The Federal Reserve, they stepped in. They forced a sale over the weekend. Most people didn't even notice it. Summer 2008, Fannie Mae and Freddie Mac, two massive companies that backed half of all US mortgages, they were drowning. So guess what? The government took them over. People started to worry, but most still thought it was contained. Then, September 15th, Lehman Brothers filed for bankruptcy. $600 billion in assets, 158 years old, gone. The next day, a money market fund broke the buck. This is something that's not supposed to happen. You see, money markets are where you park your cash, save cash. So $1 goes in, $1 comes out. But now people who put in $1, they only had about 97 cents. So if money markets aren't safe, what is? Panic. Then AIG, the world's largest insurance company, they needed an emergency bailout. $85 billion, then more, eventually over $180 billion. Why? Because they sold insurance on all these bad mortgages, and now the bills were coming due. Then credit markets froze. Banks stopped lending to each other, not because they didn't want to, but because they didn't know who was about to fail. If you can't trust a bank across the street, you can't trust anyone. You see, businesses, they couldn't get loans to make payroll. Students couldn't get loans for college. Car dealers, they couldn't finance inventory. The whole system was seizing up. And you see, this wasn't just happening on Wall Street. In California, there's a teacher that watched her retirement account get cut in half In Ohio, a factory worker with 22 years at his job got laid off. In Florida, a retiree's house was now worth less than what he owed. You see, these weren't people who did anything wrong. They trusted the system, and the system was breaking. By October, the stock market had lost a third of its value. Trillions of dollars gone. Not just for rich people, for everyone with the 401k, everyone with the pension, everyone whose biggest asset was their home. The Treasury Secretary had went to Congress and said, we need $700 billion right now or the entire financial system collapses. So they passed TARP. That was the Trouble Asset Relief Program. Basically, it's a massive bailout. You see, people hated it, but the alternative was much worse. But even with the bailout, even with the emergency loans, even with every intervention they could think of, 9 million people lost their jobs. 8 million families lost their homes. Tent cities appeared. Soup kitchens had lines around the block. This wasn't just a recession. This was an unraveling. And it wasn't just America. Banks in Europe held these same securities. Investors in Asia held them. Countries around the world held them. You see, when Lehman failed in New York, banks froze in London, markets crashed in Tokyo, Iceland's entire banking system collapsed. The world was more connected than ever, and when one piece broke, everything shook. So the Federal Reserve did something they'd never done before. They dropped interest rates to zero. Then they started buying bonds, trillions of dollars worth, mortgage-backed securities, government bonds, anything to pump money into the system. That is called quantitative easing. So it's a fancy term for money printing, not to reward the banks, but to keep credit from dying completely. Because if credit dies, businesses, they cannot operate, families can't borrow, and the economy stops. And it worked, sort of. The financial system stabilized, markets came back, banks recovered, but regular people, it took years. Some still haven't recovered. Wages stayed flat, jobs were slow to come back, trust was shattered. Meanwhile, the people who caused the crisis, very few of them went to jail, very few lost their fortunes, some even got bonuses. Why? Because in a system built on leverage, the people at the top hold everyone else hostage. If they fail, everyone fails, so they get rescued, not because they deserve it, but because letting them fail means letting the whole thing collapse. All right, now it's time to go ahead and connect the dots. In 1913, the Federal Reserve was created. This gave the system flexibility to expand credit. In 1929, bubbles form, credit collapses, the Depression hits. In 1933, we break the gold standard domestically, we give the system more flexibility. And in 71, the gold standard was broken internationally. This gave the system even more flexibility. Then in 2008, the credit bubble forms yet again. The system nearly collapses, print trillions and bail everyone out. That was their response. So different decades, different political parties, and yet the exact same pattern. When a system gets into trouble, the response is always the same. More flexibility, more credit, more money printing. Because the alternative is a deflationary debt spiral, and that is political death. A deflationary debt spiral, it destroys everything immediately. Inflation erodes things slowly, so politicians will always choose slow erosion over immediate destruction. It's not because they're evil, but because immediate destruction, that ends careers. It ends governments, it ends the system itself. So when pressure builds, they lean the same way, every single time. Not red, not blue, but green. And here's the thing, this is not the first time. In the 1600s, the Dutch guilder was the world's reserve currency. Amsterdam was the financial center. Credit expanded, leverage built up, and eventually it shifted. Then we go to the British pound. That's when that took over. For 200 years, London ran global finance. Credit expanded again, leverage built up yet again, and then 2 world wars later, it shifted yet again. Now it's the dollar's turn. The US dollar is the global reserve currency, but it's operating the exact same way every single reserve currency before it did, on credit, on leverage, and on expansion. History doesn't repeat exactly, but it does rhyme. So here we are in 2026, same system is still running. The question isn't whether another crisis will happen, they always do. The question isn't which party is to blame, both parties run the exact same system. The real question is, if the system must create these cycles, if every time it gets in trouble the response is the same, are you ready for it? Here's the truth most people don't want to hear. If your entire financial future depends on a system that has to be constantly rescued, that is not security, that is dependency. You see, you can't control the system, I can't control the system. You can't stop cycles, neither can I. You can't vote them away, none of us can. But what you can do is build differently. You can create cash flow that does not depend on markets going up forever. You can own assets that produce income whether the economy is expanding or contracting. You see, you can structure your money so that when everyone else is panicking, you're positioned. It's not about predicting when the next crash will happen. It's about building something that works regardless. And that's exactly what we teach here at Legacy Vault Financial. Because the next wave is coming. No one can stop it. But you can learn how to surf.